Here's a crazy thought for you. What if I told you that you could be a top-performing investor by being wrong more than 3/4 of the time? I know, it sounds completely backwards, right? Well, today we're going to dig into this amazing case study from a university stock market simulation that pretty much flips conventional wisdom on its head. Let's get into it.
So first, let's just get right to the result. Out of 112 competing teams, we're talking a high-stakes, super pressurized environment, the student group we're looking at snagged a prestigious third-place finish. I mean, that's an incredible achievement no matter how you slice it.
And look, they didn't just get lucky on one big trade or something. They ended the competition with a net profit of over $6,700 on their initial $100,000 virtual capital. That's a solid 6.7% return, which blew past the vast majority of the other players. But the truly wild part is how they did it. Their win rate was only 23%. Yep, you heard that right. For every 4 trades they made, more than 3 of them were losers. This is the paradox, the big puzzle that we are going to unravel right now.
So this is the million-dollar question, isn't it? How in the world do you finish on the podium with a win that most people would call a complete and utter failure? Well, the answer is all in their strategy, which was remarkably disciplined and really well thought out. It all starts right here with their core philosophy. See, this wasn't about being a frantic day trader or trying to time every little blip in the market. Nope. This was about patience, and it was about precision. So instead of chasing every hot tip they heard, the team only executed 31 deliberate trades over the entire simulation. 31! This quality over quantity approach meant every single decision was backed by some serious research. And as a bonus, it saved them a ton of capital on transaction fees. And they were operating within a really strict set of rules. For starters, they were limited to Sharia-compliant stocks, which follow Islamic finance principles, so avoiding things like excessive debt. They also steered clear of those super speculative penny stocks by setting a minimum share price. They managed their risk by never putting more than 20% of their money into any single company, and they only focused on stocks they could actually buy and sell easily. So with those rules acting like guardrails, the core of their game plan was a strategy they called buy on structure, or BOS. Now, this isn't about blindly buying a stock just because its price dropped. It's way smarter. It's about waiting for the price to find a floor, what traders call a support level, and then, crucially, waiting for signs that other buyers are stepping in. They only pulled the trigger when it was clear that support was going to hold. Okay, so they've got a philosophy and a tactic, but how do they actually decide what to buy and when to buy it? That's where their market analysis comes in. They used a classic 2-pronged approach that separated the whole problem into 2 questions. First, fundamental analysis to answer, what should we buy? You know, is this a financially healthy company we'd actually want to own? And then second, technical analysis to answer, when should we buy it? Is the timing right for this particular stock?
And a key tool for them in that fundamental analysis was the P/E ratio. To put it simply, this just helps you figure out if a stock is cheap or expensive compared to the profits it's making. A lower PE can often be a signal that a company is being overlooked, undervalued by the market.
And this slide right here perfectly illustrates their thinking. They weren't just hunting for low PE stocks. Sure, they picked a stock like HLIBKL because its low PE suggested it was a bargain. But look, they also picked FRASKL and NESMKL, which had way higher PE ratios. So why would they do that? Well, because their awesome return on equity, or ROE, showed these companies were absolute machines at generating profits, which totally justified their premium price tag. So once they found a good company, they turned to their technical toolkit to nail the timing. They were poring over daily charts, looking for uptrends, that classic pattern of higher highs and higher lows. They used moving averages to confirm the trend was solid, and they used an indicator called the RSI to make sure they weren't buying a stock that had already shot up too fast and was due for a fall. Let's look at how this all came together in a real trade, just to make it concrete. For the stock FRAS.KL, first they identified it as a solid, healthy company. Then they waited patiently, just watching the charts until a clear uptrend formed. Then they executed the trade, using their buy-on-structure strategy near a support level. And this part is key. They managed the position, letting their winner run while taking some profits off the table along the way.
And that right there brings us to the most important part of their entire strategy and really the secret to their success. It wasn't just about buying right. It was all about knowing exactly when to get out.
This is the crucial point right here.
Their success wasn't defined by their winning trades. It was defined by how they handled their losing trades. This is the key to solving our entire paradox. You see, they had a non-negotiable exit plan for every single trade before they even clicked the buy button. A cut loss was their safety net, placed just below a support level to automatically sell if things went south. A take profit was their target, set near a resistance area. You can think of that as a price ceiling, where a stock has struggled in the past. But notice the difference. Cutting a loss was a hard and fast rule, while taking a profit could be partial. That allowed them to ride a strong trend even further. And here you can see it in action. For every stock, they knew their entry, cut loss, and target prices in Malaysian ringgit before they did anything. Now check out that last one, MCLN.KL. The report said this was a more volatile stock, so what did they do? They set an incredibly tight cut loss, risking only about 9% on that trade. That's what active risk management looks like.
Okay, now we have all the pieces of the puzzle. It's time to put them all together and finally officially solve the paradox we started with.
So let's just recap the mystery. A third-place finish, a positive net profit, but a shockingly low 23% win rate. So how on earth did they do it? The final report makes this seemingly impossible contradiction make perfect sense. Here it is, the entire explainer in a single sentence. The key was not how often they won, but how much they won when they were right, compared to how little they lost when they were wrong. And this chart just says it all, doesn't it? Because of their super strict cut-loss strategy, their average losing trade was just a small, manageable loss. But because they let their winners run, their average winning trade was significantly larger. Those big wins more than paid for all the small, disciplined losses along the way. As the team themselves put it in their report, the strategy worked because their reward-to-risk ratio was positive. In other words, for every single dollar they risked on a trade, they were aiming to make multiple dollars in profit. That mathematical edge is what allowed them to be profitable overall, even while losing on most of their individual trades. It's pretty amazing. And that leaves us with one final thought. We're often obsessed with being right all the time, right? With having a high win rate. But what this case study suggests is that maybe, just maybe, the smarter path to long-term profit is focusing less on how often you win and more on having the discipline to cut your losses short and let your winners ride. Could that be the real key?